Imagine it is Thursday, January 29th, 2026. You are no longer a bystander. You are a chief financial planner managing billions of dollars in family wealth. At this moment, you are standing in the cold wind on Zurich's Bahnhofstrasse. This place was once synonymous with old world security, the safe deposit box where global tycoons stored their final lifeline funds. But tonight, the air is thick with the smell of burning. A red alert just popped up on your phone screen, sending a chill through your fingertips. The U.S. Treasury has just invoked the International Emergency Economic Power Act, announcing a 39% financial stability tax on Swiss gold imports and freezing all undeclared offshore assets. This is no longer a bargaining chip in trade negotiations. This is the opening shot of the formal decoupling of the global monetary system. This marks the total collapse of the petrodollar system that has maintained global order since 1971, and the new financial iron curtain based on physical assets and hard control is falling. As you tremblingly click open your real-time exchange rate software, the familiar numbers are crumbling. The Turkish lira has free-fallen into a historic abyss of 43.3 against the US dollar. This is not just the flickering of numbers on a screen, but the free fall of the living standards of tens of millions of people. Venezuela's inflation rate has broken through the 682% barrier like a runaway wild horse. Right now, thousands of kilometers away in Caracas, a once respected neurosurgeon is pushing a wheelchair through broken streets. The wheelchair is not carrying a patient, but bundles of bolivars amounting to hundreds of millions. He is transporting these papers with such effort merely to exchange them for a carton of eggs. Meanwhile, on the other side of the world, pensioners in Tokyo discover that the purchasing power of their life savings in yen has silently evaporated by 1/3 over the past 18 months. This is not the script of a dystopian movie. This is the real picture currently unfolding within the capillaries of global finance. But among your client list, the fate of wealth presents a suffocating polarization. Those clients who heeded your defensive advice back in 2020 are now calmly watching their net worth achieve exponential growth. Gold prices have just breached $5,529 per ounce, and silver is launching an attack on $119. Meanwhile, the remaining clients who only held cash, treasury bonds, and bank deposits are experiencing a silent massacre. They're like frogs in boiling water, watching helplessly as the purchasing power of a lifetime turns into the ashes of the era, while the numbers in their bank accounts remain unchanged. In your 30-year career, you have dissected failed economies countless times, from the denarius of the Roman Empire to the mark of the Weimar Republic. Your experience tells you that the death of a currency is never a random black swan event. It follows a pathological process as precise as a DNA map. According to your diagnosis, we are now in the terminal stage of this cancer, which economists call the stage of fiscal dominance. When a country's debt interest payments begin to exceed its defense budget, this is no longer just a fiscal deficit problem. It is a mathematical singularity. Look at the United States today. The debt scale is approaching $38 trillion. The interest the federal government pays to creditors every day has actually exceeded the entire annual national defense budget. Such extreme proportions have historically only appeared during large-scale wars. This means that no matter how hawkishly the Fed chair claims to fight inflation, they ultimately have no choice. Because if high interest rates are maintained, the government will immediately go bankrupt due to the inability to pay interest. If rates are lowered, inflation will spiral completely out of control. In this dilemma, history proves that the government will only choose one path, which is to implement yield curve control, forcing Treasury bond rates artificially lower than the inflation rate. This is what is known as financial repression. The government must keep the inflation rate higher than bond yields for a long time, effectively forcing everyone holding bonds or bank deposits to pay an invisible tax to the government at a rate of 5% to 10% per year. This is a carefully designed wealth transfer mechanism that quietly sucks dry the purchasing power of savers to dilute national debt without passing legislation to increase taxes. A more cruel truth lies in the so-called Cantillon effect. The 18th century Irish economist Richard Cantillon discovered long ago that when new money is injected into the system, it is not distributed evenly. It flows like viscous honey, going first to those closest to the printing press, namely the government, big banks, the military-industrial complex, and tech giants. These privileged classes can use this freshly printed money to buy assets before prices rise. By the time this money circulates through layers and finally reaches the general public, prices have already skyrocketed, and the money in hand has depreciated. Today, in 2026, this effect is causing a complete fission between asset prices and the real economy. We see the stock market hitting new highs amidst an economic recession, and real estate prices continuing to skyrocket despite extremely low rental yields. This is not a signal of economic prosperity, but a mirror image of currency devaluation. As a financial planner, your core task is not to help clients make money, but to help them pick a side. You must place them closest to the printing press, or at the top of the inflation chain, converting wealth into hard assets capable of absorbing excess currency. Against this macroeconomic backdrop, only 5 types of assets can cross the line of fire and survive. At this stage, if you are still staring at the historical high of $5,529 that gold hit today, you have missed the point. The core logic here lies not in price appreciation, but in the legal attributes of the asset and the fatal decoupling of financial derivatives from physical assets. Let us delve into the underlying code of the financial system, which is Basel III. This is the regulatory Bible of global banking, which quietly redefined gold as a Tier 1 asset, giving it equal status with cash and treasury bonds, with a risk weighting of 0. This means gold is no longer a so-called barbarous relic. It is the core collateral on bank balance sheets. This is also why global central banks went crazy buying $150 billion worth of gold in 2025. These elites who control the printing presses are not investing. They are engaging in balance sheet replacement, swapping increasingly depreciating credit assets for physical assets. But there is a huge trap here, which is exchange-traded funds, ETFs, and unallocated gold accounts at banks. In a normal market environment, they provide convenient liquidity. But in a systemic crisis, they contain massive counterparty risk. Many paper gold contracts do not have full physical backing. This phenomenon is called rehypothecation. When panic strikes and everyone demands physical redemption, you will find that behind every 100 paper gold contracts, there may be only one real gold bar. Therefore, in the survival strategy of 2026, you must emphasize holding allocated physical gold. Legally, allocated gold means specific bars have your serial numbers. They are your private property and do not belong to the bank's balance sheet. Even if the bank goes bankrupt, creditors have no right to touch your gold. This is the final firewall for your wealth and must be completely isolated from the banking system. In addition to traditional inflation risks, investors in 2026 face a new, more aggressive enemy: central bank digital currencies, CBDCs. This is not just the digitization of currency. This is the programmability of currency. When cash is phased out, all wealth becomes code in the central bank's database. This means the government can implement negative interest rates on currency, deducting holding fees directly from your digital wallet to force you to consume. Or they can set an expiration date, where currency automatically disappears if not spent within a specified time. Even more terrifying is the precision of capital controls. In the Lebanon crisis, banks simply froze accounts. But in the era of digital currency, algorithms can precisely forbid you from buying gold, exchanging foreign currency, or even spending in specific areas. This is why you need to understand the endgame of the Triffin dilemma. When a country's sovereign currency acts as a global reserve currency, it inevitably faces a conflict between domestic monetary policy and international liquidity demands, eventually leading to credit collapse. To cope with this endgame, the core strategy of hard currency defense is geographic arbitrage and jurisdictional diversification. Simply holding US dollars is no longer enough, because the dollar itself is in the process of full digitization. What you need is diversity of jurisdiction. The Swiss franc is backed by political neutrality and a tradition of privacy. Despite facing pressure, it remains Europe's last bastion. The Singapore dollar relies on being an Asian physical trade hub, and its currency issuance is strictly backed by physical assets. The smartest strategy is to build an offshore moat, which means holding assets in a jurisdiction outside your tax residence. Remember, when the ship of your domestic currency catches fire and the captain decides to lock the cabin doors, what you need is a master key to the outside of this system in your hand. Buying stocks during an economic collapse sounds crazy, but Venezuela's stock market data will shatter your common sense. The Caracas Stock Exchange Index skyrocketed by 3,400% in just 9 trading days. The deep logic behind this is the replacement cost theory. Imagine that if the currency depreciates by 50%, the cost of building a new copper mine, laying a new railway network, or establishing a global food supply chain will double. Therefore, the nominal value of these existing physical assets with extremely high replacement costs must inevitably skyrocket to reflect the decline in currency purchasing power. This is a defensive rise, which we call a hyperinflationary boom. But the screening criteria must be extremely strict. You need to avoid growth tech stocks that rely on credit expansion and turn to value stocks. The real winners are those companies with global pricing power. Imagine a coffee exporter in Venezuela. Its workers' wages and operating costs are paid in depreciating bolivars, but its products are sold to international markets earning strong US dollars. As the local currency depreciates, its actual costs approach zero, while revenue soars, leading to explosive growth in profit margins. The same logic applies to giants with global brands like Apple or Nestle, which can pass inflationary pressure to consumers without loss. Or mining companies like Rio Tinto and BHP Billiton that control scarce resources. In an inflationary tsunami, such companies are not just safe havens, they are machines that utilize the Cantillon effect to harvest wealth. You need to look for companies whose revenue sources are decoupled from the domestic currency, while their cost structures benefit from the dividends of local currency devaluation. When you cannot withdraw money from banks, ATMs are down, and electronic payment systems are paralyzed due to power or network failures, what is real liquidity? We must redefine the concept of money. In physics and ecological economics, the essence of money is a token of energy. When financial symbols fail, the world will revert to the logic of energy return on investment. In post-World War II Germany, cigarettes became currency because they were standardized units of dopamine energy. In the context of 2026, equipment that can generate or store energy will become the hard currency of the new era. What we are seeing is not just supply chain ruptures, but the fragility of energy networks. Portable, high-capacity batteries, solar panels, diesel generators, and corresponding fuels. These supplies, which seem unremarkable in peacetime, possess an infinite liquidity premium when the system freezes. Furthermore, the phenomenon of medical supplies becoming quasi-currency cannot be ignored. In the black market trades of Venezuela and Cuba, the purchasing power of a box of antibiotics often exceeds a month's minimum wage. Antibiotics, potent painkillers, insulin, and sterile first aid kits. These items feature high value density, easy storage, and rigid demand. Allocating 5% of total assets to these strategic supplies is not survivalist paranoia, but a physical option prepared for extreme situations. When fiat currency fails, these items in your warehouse will be the only currency that maintains the dignity of survival for you and your family. Land, especially agricultural land, is the ultimate bottom line of human survival. During the Great Depression, when the urban middle class lined up for relief food, farmers, though tight on cash flow, never lacked food on their tables. No matter how currency devalues, the calories produced by land are always hard currency. However, directly holding agricultural land is extremely dangerous, as there are three huge traps. First is the liquidity lock-in. You cannot run away with the land. Second is tax harvesting. Land cannot be hidden, and the government can levy windfall taxes at any time. The most terrifying is the risk of political expropriation. Look at the lesson of Zimbabwe, where a single decree from the Mugabe government caused countless farms managed for generations to change hands overnight. Therefore, investment targeting agricultural land must be extremely shrewd. A smarter approach is to hold agricultural real estate investment trusts, REITs, or shares in multinational agricultural companies. But a critical dimension must be added here, and that is water rights. In the future era of resource scarcity, the value of agricultural land with control over water sources will far exceed that of ordinary dry land. Water will become the oil of the 21st century. By holding shares in enterprises that possess land reserves in water-rich regions like Canada, New Zealand, or parts of South America, you not only enjoy the inflation dividends brought by rising agricultural product prices, but also maintain immediate asset liquidity. Most importantly, you avoid the risk of direct confiscation through complex legal structures. We want exposure to food production, not to become serfs trapped on the land. Before talking about how to make money, we must first ensure we are not wiped out. In the script of currency collapse, two types of assets are destined to go to zero, which requires you to immediately assist clients in a major cleansing of their balance sheets. Death Trap 1. Long-term fixed income securities, denominated in local currency. Bondholders in Weimar Germany eventually found that the government bonds in their hands had too low a calorific value even to be used as fuel. Bonds are essentially your claim against the government. When the government decides to devalue the currency to default on debts, your claim becomes a piece of waste paper. Even if you nominally recover the principal, you are effectively bankrupt in terms of actual purchasing power. This is not just market risk, this is a logical inevitability. If you hold a 30-year Treasury bond while inflation soars to 15%, you are practically donating your wealth to the government every year. This is not just an investment mistake, it is an act of charity. Death Trap 2. Bank deposits and bailin legislation. Depositors in Lebanon, Cyprus, and Greece have all proven a truth with blood and tears. In the face of a systemic crisis, money in the bank is just pixels on a screen. This is not lawlessness, but action based on law. According to bank bail-in legislation, passed in many European and American countries, when banks face bankruptcy risks, they have the right to forcibly convert depositors' savings into bank equity. This means your savings become stocks of this bankrupt bank. This is no longer a conspiracy theory. These are clauses written in Title II of the Dodd-Frank Act and the European Bank Recovery and Resolution Directive. The lesson of history is very cold. Never become an unsecured creditor of a failed state or a bankrupt bank during a crisis. The alarm has sounded, and the time window left for us is closing. The distortion of the U.S. Treasury yield curve, geopolitical friction, and the frenzy of central bank gold purchases all point to the same endgame. As a financial planner accustomed to cycles, you know very well, the guardianship of wealth never happens after the storm arrives, but when the dark clouds are just gathering. When everyone realizes they must escape, the exits are usually already blocked. You still have the power to choose right now. You can choose to ignore these signals and continue sleeping in the illusions of the old world. Or you can start acting now, ensuring you already hold the ticket to the new order while your neighbor is still worrying about the price of bread. If this autopsy report has opened a new perspective for you, please subscribe to this channel. We only analyze the underlying logic that Wall Street does not want you to see. If you are ready to build fortifications for your family, please leave a comment with what you think is the safest asset. Is it gold, land, or something else? Let us exchange intelligence in the comments section. I will seriously reply to every valuable comment. Remember, patterns are mathematical and predictable. The only question is, when that moment comes, will you be standing on the ark or in the water? Diversify your allocation now, before you are forced to do so.